Okay, so in this video, I'm going to take a look at the RSI. This is the Relative Strength Index Oscillator. It is a secondary indicator. It was developed by J. Wells Wilder, a guy who actually invented several indicators out there that are popular. It's a momentum oscillator that measures the speed and the change of price movements. It goes between 0 and 100, and you can see that there are levels at 70 and 30 marked off. So if we were to break down below 30, then it's considered to be oversold. Overbought is above 70. The idea being is that the momentum has gotten ahead of itself one way or the other as we move along. Now, this is a secondary indicator, and you'll see that it's difficult to trade it based purely upon itself. But I would go ahead and point out, let me go ahead and change my tool to an ellipse, and I would point out that as we got into the overbought area here on the weekly chart, we did drift a little bit lower. We got into overbought here, and we did drift a little bit lower. But this is probably the best signal. And the reason for that is because we're clearly overbought. We have formed a 2-week shooting star, if you will, which of course is a negative sign. You can see, though, that since then we got oversold twice, and it was the second time that I actually took. This bounced slightly and then continued lower. So, because of that, you have to be a little bit careful. Now, what do you use as a filter? Well, for me, the simplest thing to pay attention to is, are you overextended? Do you have a candlestick pattern? Do you have a large round number? This here coincides with 120, so that made sense that we're oversold and we're reaching an area like that. So be careful about using these secondary indicators. But, if you have a nice price action set up like this here, for example, and you're overbought, then it just gives you more confirmation. And that is the trick with all of these secondary indicators. There are literally dozens upon dozens of them, but I'll look at a few of the most common ones in these videos and give you an idea as how they could be helpful. But clearly you can't buy and sell just based upon them by themselves. So, for example, if you sold as soon as you got into the overbought region, here you can see that you would have been in a lot of pain, because remember, this is a weekly chart. That's 1,000 pips. So clearly you would have to be a bit cautious. It does help. The higher time frames do tend to be a little bit more reliable. But this is a 4-hour chart, and you can see how it's worked out. It does tend to work itself out over the longer term. I prefer, though, to go with the trend. So if we're going higher longer term and we get a little overbought, pulled back, and a little oversold, but still in a longer term uptrend, then I'm more comfortable buying, because it's gotten ahead of itself to the downside in an uptrend. So keep that in mind as well. Trend should always be the first thing you pay attention to. Price levels, candlestick patterns, bar patterns, and then these indicators here can, of course, help as well. I call them secondary because typically you get something like price action at a level, and then you go looking towards these.